We faithfully deliver value by interpreting great books from around the world. Hi, this is Sally from Book Talk. Today, we're exploring the book Seeing Through Credit. The author, He Huping, used to work at the Agricultural Bank of China in Beijing, focusing on credit for years. And now he's at the China Securities Regulatory Commission, handling financial oversight. And he's an expert in credit laws and regulations. Plus, he's got tons of hands-on experience in credit operations. So, his deep dive into China's bank credit scene offers real useful advice for both lenders in finance and folks like entrepreneurs and individuals seeking bank loans. The book covers three main parts. One, it introduces the key players and business types in the credit market. And two, it explains how banks check out borrowers, loan projects, and guarantees. Three, it details the whole workflow of bank credit operations. Now, I'll break them down for you step by step. First off, we'll chat about the folks and happenings in the credit market. The credit market involves three key players: lenders, borrowers, and third-party outfits. First up, lenders. The author sorts China's current lenders into four big groups. The first group is banks, like policy banks, the Big Five: Industrial and Commercial Bank, Agricultural Bank, Bank of China, China Construction Bank, Bank of Communications, plus local joint stock banks and foreign or private banks. Second up, non-bank lenders that don't take public deposits, like trust firms, corporate groups, finance companies. The third group is lending outfits that neither take public deposits nor are regulated by the CBIRC, including microloan companies, pawn shops, guarantee firms, various private lending forms, and recently emerged online lending companies. Fourth is unique, it's regular businesses. In their deals, they offer things like commercial papers and credit lines to suppliers and customers up and down the chain. This is similar to loans. For example, Alibaba's Hubei, JD.com's Baitao, Kuna's Nakwa can be used directly as money. Next role is borrowers, split into three. One, individuals like consumers, sole proprietors, and rural contractors. Second, legal persons, mainly including for-profit ones, like limited companies and joint stock firms, and non-profit ones, like public institutions, charities, and grassroots mass self-governing groups. For-profit legal entities can use their assets for mortgages and guarantees. If the bank can't recover loans, these assets can be liquidated. But for nonprofit entities, any assets tied to public interest can't be used for mortgages or guarantees, and banks can't seize or sell them. Regardless of entity type, shareholders or actual controllers aren't liable for debts beyond their equity investment. The third category is unincorporated organizations, including sole proprietorships and partnerships. Unlike corporate entities, their actual controllers and general partners bear unlimited liability with personal assets for company debts. And another credit market player is third-party institutions like credit agencies, accounting and law firms, insurers, notaries, and judicial bodies. These third parties provide credit assessments, legal advice, notarization, arbitration, and similar services to both lending sides. That covers the three main players. Now let's discuss the four major credit business types. First is lending. Working capital loans, fixed asset loans, project loans, acquisition loans, personal business loans, and consumer loans. Working capital loans are short-term corporate financing with flexible use, while fixed asset, project, and acquisition loans are all business-focused. Loans exceeding 1 year generally require dedicated use for specific purposes. Personal business and consumer loans target individuals for operational needs and daily spending, respectively. Second is bill financing. When businesses can't pay partners immediately, they issue IOUs promising payment by a set date. These IOUs are formally called commercial acceptance drafts or trade bills. The business holding such a draft can approach banks for immediate cash if they need liquidity. After risk assessment, the bank accepts the draft. It pays the business a percentage of the face value in cash. The business gets funds, the bank earns the spread as fee, creating a win-win. Third is trade finance and supply chain finance, closely tied to commerce. In bulk transactions, Sellers typically want buyers to prepay so they can purchase materials and initiate production. Meanwhile, buyers prefer getting goods on credit first to test sales, avoiding big funds tied up in inventory. Here's where banks mediate. They issue letters of credit at buyers' request, promising payment to sellers at specified dates after delivery. This gives sellers payment assurance for confident shipping, while buyers avoid capital lockup, just paying banks a small fee. Beyond letters of credit, sellers can also mortgage sales contracts to banks for early cash. This is called factoring. They can also pledge goods as collateral for funds. Simply put, when businesses pay service fees, banks create payment solutions satisfying both sides. Supply chain finance works similarly. Banks provide credit guarantees across transaction stages to facilitate deals. Here, banks better control fund or goods flow, monitor actual loan usage, and reduce risks, making a trend toward replacing working capital loans as primary business solution. The fourth category, recently developed, includes delegated directional investments, return swaps, and similar quasi-credit services where non-bank institutions use banking licenses to operate. Here, banks bear no credit risk, just using their reputation as guarantee to collect fees, known in the industry as channel business. In essence, the credit market involves lenders, borrowers, and third-party service providers. They strategically interact around four pillars: loans, bills, trade supply chain finance, and channel business, all to price risk appropriately. That concludes part one. Now we'll explore part two: banks' investigation methods for borrowers, loan projects, and guarantees. Banks lend based on two conditions: proven repayment sources and collateral assets they can liquidate if repayment fails. The best way to verify repayment sources and assets: examining historical records.
Generally, businesses that consistently handle payment settlements with us, like receiving and paying funds, tax payments, payroll, give banks clear visibility into their cash flow, making repayment sources and asset verification easier.
With solid records, these companies become prime banking clients. Additionally, top taxpayers, industry leaders, and supply chain partners of existing clients also qualify as preferred banking customers. In contrast, banks are wary of new micro-enterprises with unstable performance, prior loan rejections, or credit blemishes. For new clients, banks investigate via the PBOC credit system, business registration databases, and national corporate credit platforms. Third-party tools like Tianyancha, Chichacha, and Chishenbao, fueled by internet tech, provide more efficient investigation channels. Bank investigators simply search a company's name plus keywords like default or lawsuit to gauge its creditworthiness. So loan applicants must vigilantly protect their reputation. Any credit stain matters. But investigations aren't that simple. The author encountered two major headaches during credit operations. First, borrowers exploiting corporate limited liability for fraud. As mentioned earlier, lenders are more lenient with personal loans, whether for consumption or business. Why? China lacks personal bankruptcy laws. Individuals bear lifelong unlimited debt liability. Hence the saying, debts don't expire until death. Personal obligations last forever, unlike corporate ones. Under corporate law, legal entities enjoy limited liability and can declare bankruptcy. If a company goes bankrupt, banks can only liquidate remaining assets, no recourse to shareholders or controllers. Thus, some controllers exploit this, borrow through companies, drain assets, then bankrupt them to escape debts. In reality, major shareholders often abuse company assets, embezzling funds, withdrawing capital, and transferring properties. When banks pursue major shareholders for repayment, they must prove bankruptcy resulted from controllers personally draining corporate assets. But in practice, management often colludes with shareholders, making it extremely hard to find concrete evidence of asset stripping. Much bank bad debt stems from corporate entities maliciously evading obligations. These shell companies come and go without caring about reputation or credit history. Superficial risk controls don't work. Banks must deeply examine ownership structures before lending, identifying true controllers and making them sign joint liability guarantees. The second headache? Group clients' related party transactions. Having group in the name doesn't define them in credit contexts. It means all credit entities controlled by one actual controller. Why be extra cautious with group clients? Because many controllers register numerous companies to create complex related party deals for loan applications. Individually, each company looks solid, real trade background, steady cash flow, and cross-company guarantees. But when defaults happen, investigations reveal these related companies act as each other's customers.
They self-trade and cross-guarantee to fabricate operations, inflate assets, meet bank requirements, and secure massive loans.
To prevent shell-based evasion and fabricated group data, lenders implement two measures. First, internally separate loan approval from sales, different departments for client acquisition versus credit review, not just separate personnel and offices. They're evaluated differently. Sales on client volume, not approvals. The loan review department primarily monitors risk metrics like delinquency rates, default rates, and non-performing ratios.
Second, operationally, during borrower financial and operational due diligence, beyond routine checks, special attention must prevent controllers from asset transfers, hollowing out companies, or group clients fabricating through related party deals. 1.
Particular vigilance is needed when analyzing borrower financial statements. Is the legal entity a going concern, or just a shell created for specific purposes? For instance, companies drowning in debt yet constantly investing often hide controllers, shifting assets through equity investments, yielding no returns.
Lack of cash inflow typically signals fund misappropriation or improper benefits transfers.
When a firm's revenue concentrates in few clients with disproportionate one-time payments, and receivables linger unpaid from those same parties, related party transactions likely exist. Group clients using related deals to divert funds, inflate revenue, and polish profits severely undermine bank due diligence. So how can banks crack shell companies and related party scams? The author advises investigators to scrutinize annotated sections in financial audit reports. Because Chinese auditors often avoid direct criticism to preserve client relationships. Thus, any footnotes or comments warrant careful interpretation for hidden meanings. Another key point, watch for figures deviating significantly from industry norms. Say peers average 10% gross margins, but one firm hits 25%. Without proprietary tech supporting its products, that high margin is likely artificial. Rather than genuine, it's fabricated through related deals. When assessing borrowers, the core task remains identifying shells and related party schemes. Lenders prefer focused businesses. Diversified ones with scattered operations are fertile ground for related party transactions. True operational health is hard to verify. Judging sustainable operations hinges on profit models and core competitiveness. The author observed many companies with bizarre profit models in credit practice. Some controllers turn firms into financing shells, constantly raising funds via bonds or private placements, or using equity as collateral for loans, then funneling money into real estate for interest spreads. Seeing retail's minimal credit sales, steady cash flow, and supplier fund leverage, many owners rush into distribution, supermarkets, pharmacies, specialty stores, diverting working capital into stock speculation during cash float periods, or property flipping. Others exploit initiatives like new rural construction or digital industrial parks, profiting not from products, but by grabbing policy perks, cheap land, and subsidies. The author warns, such profit models won't stand the test of time. When monetary policy cycles shift, their operations and finances immediately falter. Long-term banks should engage firms with core competitiveness.
Core competitiveness means product superiority or pricing advantages unmatched by competitors.
That concludes our discussion on borrower investigations. Beyond borrowers, banks must examine loan projects, since long-term loans need justification, usually for new initiatives. But what about project risks? That's a key investigation focus too. Project reviews cover compliance and repayment capacity. First, compliance checks. For this, there's a well-known 4-3-2 rule in the industry. 4 means 4 permits: land use planning, state land ownership, construction planning, and construction commencement. 3, The firm's equity investment must be at least 30% of total project cost. 2. Contractors need national grade I or higher qualifications. Next, assessing repayment capacity. Banks rely on agencies like the NDCR, MIIT, and MOHERD for vetting. Based on these agencies' approvals, they verify if new projects have advanced technology or equipment, market potential, and timely economic returns. That's essentially how loan project investigations work, what lenders focus on examining. The third focus is borrower collateral. Assets banks can liquidate if repayment fails. Credit guarantees mainly fall into three types: mortgages, pledges, and sureties. Mortgages and pledges both use borrower-owned assets as security. Upon default, banks auction these to recover debts. The difference: mortgages don't transfer assets to banks, while pledges require physical handover. Sureties involve third parties. Banks require borrowers to find guarantors who commit to repaying if borrowers default. The industry calls mortgages, pledges, asset guarantees, and sureties personal guarantees. Guarantee risks center on 2 points: eligibility, which assets and providers qualify, and enforceability during default, and whether pledged assets can be liquidated easily, or if surety commitments hold legal weight. Chinese law prohibits mortgaging land ownership, farmland, homesteads, etc. While trademarks, patents, copyrights can be pledged, liquidation is extremely difficult. Don't count on selling them to repay loans. Hence, banks typically reject such collateral. Particularly dangerous are guarantee circles. Same region/same industry firms cross-guaranteeing with assets. When one circle member fails, synchronized industry downturns devalue all collateral simultaneously, complicating bank recovery. Cross-guarantee triggered bad loans frequently erupt in credit practice. Note: per property law, mortgage or pledge contracts must be promptly registered with authorities post-signing. Registration timing determines liquidation priority during asset distribution. That covers banks' investigations into borrowers, loan projects, and guarantees. Remember, this is just step 1 in credit operations. Generally, the entire credit process involves 6 key steps from loan application submission to repayment. If you're seeking a loan, it's wise to understand this full process. Now we'll explore part 3. Let's examine the credit workflow from the lender's perspective. When submitting loan applications, clients first receive a credit rating questionnaire from relationship managers. If you meet most preferred client criteria mentioned earlier, the bank system will score you highly after review. High-scoring clients then sign agreements in VIP rooms, securing repayment sources for the bank. For instance, entrusted payment agreements ensure loans aren't fully dispersed to your account up front. Instead, banks pay suppliers directly when actual needs arise, like settling invoices. After signing, you await further updates. Meanwhile, middle back office staff re-examine your details and compile review reports. After loan committee approval, the disbursement center schedules funding based on bank capital plans. After successful transactions, reliable companies receive tailored credit lines and solutions proactively. Within set periods, loans within this limit bypass most procedures for immediate disbursement. But default or delinquency immediately changes the bank's stance. On day 1 of delinquency, your manager texts. If unresolved, calls or visits follow for collection. This reflects strict risk controls on lent capital.
Loans are risk rated in 5 tiers: normal, special mention, substandard, doubtful, loss. The last 3 being non-performing loans.
After 90-plus days overdue, loans get downgraded to substandard. This signals clear repayment issues. Normal revenue can't cover principal or interest, and collateral liquidation would cause losses. After further assessing your company's operations and finances, the bank may escalate the loan risk rating to doubtful or loss based on actual conditions. This means the bank concludes you absolutely cannot repay. Even liquidating collateral would only cover part of the debt. Once rated substandard or higher, a fundamental shift occurs. The loan must transfer to the bank's risk asset department as non-performing credit. This also means your relationship manager can no longer assist. You'll face the bank's collection measures alone. If routine collections fail, banks negotiate non-performing loan restructuring. extending terms, or changing debt entities to give you more time and flexibility. Ultimatum tone signaling last resort. If restructuring fails, the final step is judicial collection.
Banks file lawsuits to seal, seize, or freeze assets for preservation, enforcing collection after court rulings.
That concludes the full credit process. With this, we've covered all essential content of this book. The author's long tenure at banks and the CBIRC means he observes credit markets from financial institutions' perspective, focusing on lender risks. Stepping beyond this view reveals the biggest default risk: a stagnant real economy. When financing stays difficult and expensive, honest manufacturers and service providers can't earn enough to cover interest. Long-term, banks lose quality clients. The greatest moral hazard comes from non-market-driven interest rates, creating huge funding spreads.
On one side, average annual bank loan rates sit at 4 to 5%.
While double-digit rates in sectors like real estate are common, such spreads inevitably tempt shell companies and related party schemes to divert bank funds into property speculation. End quote. Why are shell companies and related party fraud rare in mature credit markets? Because exposing them isn't technically hard. What's crucial is stronger financial market penalties, self-correction mechanisms, and eliminating regulated interest spreads and state credit guarantees. Financial institutions that willingly fall for scams will inevitably lose everything in real market competition and exit in disgrace. All right, that's seeing through credit. That concludes our interpretation of this book. Reading notes are below the audio. See you next episode.